All right, ready to dive in. Today we're tackling financial data and portfolio analysis.
Sounds exciting.
It is.
Yeah.
We've got excerpts you provided from a document simply titled,
44.
yeah, Financial Data and Portfolio Analysis.
Love it. Getting right to the point.
You know, this deep dive is all about helping you become a smarter investor.
Absolutely.
Whether you're, seasoned or just getting started,
Right.
we're all about informed financial decisions.
Couldn't agree more. I always say garbage in, garbage out.
True.
Especially with investing,
Oh, yeah.
If you're using bad data, well, it's like building on quicksand.
Makes sense.
So data's key, right? Let's talk types.
Okay, so data is the foundation, but where do we even begin? What kind of data are we talking about?
All right, so think of it like a recipe, right? You need a few key ingredients.
Okay.
First up, market data.
Market data.
Stock prices, indices always moving, commodities, gold, oil, that stuff.
Like checking the vital signs of the market.
Exactly. Shows us the pulse, historically, right now.
Right now.
Then we got to zoom out.
Zoom out
A
how?
bigger picture, economic data,
Okay.
GDP growth.
Uh-huh.
Inflation, I'm sure you've heard about that lately.
Oh, yeah.
Even, big political events, those can shake things up.
Definitely feels like there's always some news that sends the market on a roller coaster.
Right. Almost like being a detective.
I was just thinking that.
Ow.
Piecing all those clues together.
You got it. And finally, we got to get up close and personal.
Up close with what?
The companies, their financials.
Okay.
This is where company data comes in. We're digging into statements, income statements, balance sheets,
To see this.
see their health financially,
Okay.
like calculating those key ratios, price to earnings ratio, for example.
Price to earnings.
Helps us see if the pricing's fair compared to, well, their earnings.
I'm seeing how crucial this data is.
It is.
But honestly, so many sources, it's overwhelming. Where should a beginner start?
That's a great question. For a quick check, Yahoo Finance is a good starting point.
Yahoo Finance.
Yep, Morningstar's my go-to for mutual funds, ETFs, that kind of thing.
Got it.
And if you're, into the charts, technical stuff,
Yeah.
investing.com, TradingView, those are fantastic.
There's something for everyone, it seems.
There is.
But you mentioned bad data.
Right.
How do we avoid that trap?
Choosing reputable sources is key,
Makes sense.
Bloomberg Terminal's the gold standard, but pricey.
Ever heard that?
Refinitiv's another solid option.
Okay.
And remember, free data can be helpful, but
Great.
you got to understand its limitations. Always double check and make sure it's up to date.
Up to date, double check. Got it.
Good. So now we've got our data, all organized, reliable.
So what's next? How do we actually use it to analyze our portfolios?
That's where the real fun begins. This is all about making sure those investments align with your goals, your risk tolerance,
Sounds like putting those ingredients together and creating the perfect investment recipe.
Exactly. And there are a few key parts to that recipe. First, asset allocation.
Asset allocation.
Spreading those investments, different asset classes, stocks, bonds, real estate, you name it.
Like the old saying, don't put all your eggs in one basket.
Diversification, super important.
Diversification, right. I've heard that's crucial.
It is. And within each class,
Yep.
you diversify even further, different sectors, industries, even geographies.
You had to risk, I got it.
Exactly. So it's bigger picture thinking, how everything works together.
Not just picking stocks then.
Right. And next, we got to see if they're actually, performing, meeting expectations.
Makes sense.
That's where performance measurement comes in. Think of it as a report card.
Okay, I like that.
Use different metrics, see how we're doing, compare to a benchmark, all that.
How do we measure that performance? Is there like a magic formula?
Well, there are a few key metrics we use. Absolute return, that's just, how much your portfolio gained or lost over a period.
Okay, simple enough.
But we also need to factor in risk. It's not just about making money, it's how much risk you took to get there.
High risk, high reward rate.
Well, not always. That's where metrics like the Sharpe ratio come in.
Sharpe ratio.
It tells you the return per unit of risk. Higher Sharpe ratio, well, often that suggests better performance, considering the risk you took.
So it's about the return in relation to the risk. Makes sense.
Exactly. And speaking of risk, that's our next stop, risk analysis.
Risk analysis. This is where it gets scary for a lot of people, myself included.
I understand, but remember, risk is part of investing. The key is to understand it, manage it right. We
Right.
use tools like volatility, measures those fluctuations in your portfolio's returns,
Okay.
and beta measures how sensitive your portfolio is to market movements.
So it's like assessing our portfolio's tolerance for a roller coaster ride, right?
Okay.
Some love the thrill, others prefer a smooth journey.
That's a great analogy. It comes back to knowing your risk tolerance.
Knowing yourself is key.
Some investors are cool with big swings. Others, well, they prefer a smoother ride.
So we've talked asset allocation, performance, and risk analysis. Anything else to consider?
One more, it's about how those investments interact. We call it correlation and diversification.
Correlation and diversification.
Basically, analyzing how different assets move in relation to each other.
So they're dancing together, but hopefully not stepping on each other's toes.
Exactly. If one zigs while the other zags, it helps smooth out those bumps in your portfolio. That's the heart of diversification, right?
Yeah.
Not putting all those eggs in one basket.
This is making portfolio analysis feel less daunting and more like a strategic puzzle.
That's a great way to put it. Now that we understand those building blocks, let's talk tools to build your ideal investment house. But that's for part 2. Welcome back. Last time we dug into data sources, portfolio breakdown, those challenges and best practices, right?
Right. Feels like we covered a lot of ground.
Now let's take it up a notch.
Level up.
Exactly. Some techniques that can really refine your analysis.
Okay, I'm ready. What's first?
Let's circle back to modern portfolio theory, MPT.
MPT.
It's a powerful tool, but, it assumes investors are always rational and they hate risk.
Is that always true?
Well, let's be real. We've all made emotional decisions, haven't we? Especially when it comes to money.
Oh, tell me about it. Fear and greed can really mess with my judgment.
Right. Remember that time everyone was raving about that hot stock?
Don't remind me. Total FOMO moment. Bought at the peak. Watched it crash.
Ouch.
Lesson learned, though.
We've all been there. That's where behavioral finance comes in, you see?
Behavioral finance.
It acknowledges those human quirks, emotions impacting choices.
Makes sense.
Like loss aversion, hating to lose money more than, well, the joy of making it.
Oh, I feel that.
It can make us hold on to those losing investments way longer than we should.
So it's not just the numbers. It's our psychology, too.
Exactly. So how do we incorporate that into our analysis?
Yeah, good question.
One way, scenario analysis.
Okay.
Instead of just past data, we create different what-if scenarios,
It's interesting.
good and bad, see how our portfolio might handle them.
Like a stress test for our investments.
Exactly. Not just looking back, but anticipating what might be coming.
Love that. Are there any other real-world factors to consider?
Absolutely. Tax efficiency is often overlooked,
Taxes.
but important. Different investments have different implications. Nobody wants gains eaten by taxes, right?
True. No one likes that.
Yeah.
Any tips for navigating those tax complexities?
Well, using tax-advantaged accounts is a good start. 401k, IRAs, those are good for long-term investments.
Okay.
And strategies like tax loss harvesting
Tax loss harvesting.
can help offset those capital gains.
Sounds complicated.
It can be. Might be worth seeking professional advice there.
Right, like a whole other level of strategy.
It is. Then there's liquidity, another big one.
Liquidity, what's that?
How quickly you can access your money, if you need it.
Oh, I see.
If you have a short-term goal and your money's tied up in real estate, that's tough to sell quickly.
Makes sense. It's like having a financial safety net. You never know when you might need cash.
Exactly. Then there's sustainability, becoming a key focus for many.
Sustainability. Yeah, I've been hearing more about that.
Investors want alignment with their values, supporting responsible companies, environmentally, socially, ethically.
It's like voting with your dollars, supporting companies doing good in the world.
Exactly that. But how do we find and analyze those investments?
Right, how do we know they're truly sustainable?
There's a whole world of ESG funds and indexes out there.
ESG?
Environmental, social, governance. They track companies meeting specific criteria.
Okay.
You can also research individual companies, see how they stack up.
So we can build portfolios that make money and
Yeah.
contribute to a better world.
Exactly. And remember earlier we touched on alternative investments.
Alternative investments. Yeah, tell me more.
Think beyond the usual stocks and bonds, things like private equity, venture capital,
Oh, yeah.
hedge funds, real estate, commodities, even crypto.
Crypto. Wow.
They can be often have higher fees, less transparency than traditional investments, but
Got
they
it.
also offer potential for higher returns and can add another layer of diversification to your portfolio.
Higher risk, higher reward.
Right. But how do you even analyze these? They seem so different from stocks and bonds.
Yeah, it feels like a whole other world.
You're right. It requires a different approach, specialized knowledge sometimes.
Okay, so like, give me an example.
Say you're looking at private equity.
Hmm.
You'd want to understand the management team, the target company's financials, the industry outlook, all that.
Sounds
But
correct.
real estate involves local market trends, property valuations, rental income potential.
And crypto.
Crypto's a whole other beast, unique risks and dynamics.
Definitely sounds like you need a different set of tools for those.
It can be. Professional advice can be really valuable here.
Got it.
Now, let's shift gears, talk about the future.
The future of portfolio analysis. Ooh, that's exciting.
It is. What trends are shaping the landscape?
That's on the horizon.
One major trend is the rise of technology, data analytics.
Okay.
Specifically, artificial intelligence, AI, and machine learning, ML.
AI and investing. Wow.
Imagine algorithms sifting through mountains of data, spotting patterns we might miss,
That's incredible.
generating insights for smarter decisions.
Like having a super smart financial advisor working 24/7.
In a way, yeah. Powerful tools, optimize portfolios, identify potential investments, even automate trading decisions.
Sounds almost too good to be true. But what are the downsides? There's always a catch, right?
You're right. AI and ML are tools. They provide insights, but
They don't replace human judgment.
exactly, we still need to interpret, make the final call.
So we're still in control, even with all this technology.
Absolutely. Another trend, growing demand for personalized advice.
Personalized, like custom-tailored advice.
Right. The cookie cutter approach isn't enough anymore. People want advice for their specific goals, risk tolerance, their life situation.
Makes sense. Everyone's financial journey is different.
Exactly. So how's the industry adapting?
Yeah, how are they keeping up?
Hybrid models are emerging, combining technology with human advisors, get the efficiency of automation, but with that personal touch, a human expert guiding you,
The best of both worlds.
right? And then there's the rise of fractional ownership and tokenization.
Fractional ownership, tokenization, those sound complicated.
Think of it like this. Fractional ownership lets you buy shares of those usually expensive assets.
Like what?
Rare art, prime real estate, making them accessible to, well, more investors?
So more people can invest in things they couldn't before.
Exactly. Tokenization uses blockchain technology to represent ownership digitally.
Okay.
Faster transactions, more efficient.
Wow, it's like democratizing investing.
It is.
Hmm.
Really dynamic time to be in the investing world.
It sounds like it. We've covered a lot, from our own biases to AI, even the future of investing.
Quite a journey.
I feel inspired, ready to take charge of my financial future.
That's great. And remember, portfolio analysis is ongoing, continuous learning, adapting, optimizing. We're all figuring it out as we go.
Speaking of figuring it out, let's talk potential pitfalls.
Pitfalls.
Yeah, what to watch out for in this complex world.
Absolutely. We'll dive into that in part 3.
And we're back for the final part of our deep dive into the world of financial data and portfolio analysis. You know, it's been quite a journey.
It has.
From data basics to some really advanced strategies.
And even a glimpse into the future.
Right. But before we wrap up,
Yeah,
there are a few crucial things we haven't touched on yet.
absolutely.
With all this focus on numbers, strategies, it's easy to forget about the human element.
The ethical side of things.
Exactly. Making responsible decisions, understanding the risks, all that.
Right. It's more than just maximizing returns.
So what are some of those ethical considerations investors should keep in mind?
Well, transparency and disclosure are key.
Transparency.
Financial professionals, they have a responsibility to be upfront with their clients
About
the risks involved, any potential conflicts of interest, all that.
Makes sense. Building trust is important.
It is ensuring everyone's on the same page.
We also talked about sustainable investing, aligning with values.
Right.
How do we avoid those greenwashing traps? Companies that just talk the talk but don't walk the walk.
That's a great point. It's all about doing your research, going beyond the marketing.
Okay.
Look into a company's track record, their sustainability reports, see if their actions match their words.
So dig deeper. Don't just take things at face value.
Exactly. There are also third-party organizations that evaluate ESG performance. You can use those as a resource.
ESG performance.
Yep, environmental, social, governance.
Right. Got it.
So be discerning, critical in your evaluation.
Makes sense.
Now, another pitfall to watch out for is confirmation bias.
Confirmation bias, what's that?
That tendency to seek out information that confirms what we already believe.
Oh, I think I do that sometimes.
We all do. It's like when you buy a new car and suddenly you see that same car everywhere.
Right.
We filter information to fit our preconceived notions.
I've definitely held on to an investment for too long, convinced I was right, even when things were not looking so good.
Happens to the best of us. Hard to admit we're wrong sometimes.
It is.
The key is to actively seek out diverse perspectives.
Yep.
Challenge your assumptions. Be open to changing your mind.
Be flexible.
Right. And remember, past performance doesn't guarantee future results.
Right. The market's always changing.
It is. What worked yesterday might not work tomorrow.
So no resting on our laurels.
Exactly. Another pitfall, overconfidence.
Overconfidence, especially after a win, right?
It can lead to taking on too much risk, making impulsive decisions.
Pride comes before the fall, as they say.
Exactly. Stay grounded. Even the most experienced investors make mistakes, you know?
Humility is key.
It is. And then there's herd mentality.
Herd mentality, following the crowd.
Yeah, when everyone's piling into something, it's tempting to join, that fear of missing out.
FOMO.
But it can lead to bubbles, painful losses when those bubbles burst.
Like everyone rushing to one side of the boat and capsizing it.
Exactly that. Think for yourself. Make decisions based on your own research, your assessment.
Don't just follow blindly.
Right. And lastly, remember, portfolio analysis isn't an exact science.
There's always some uncertainty.
There is. We're dealing with complex systems, trying to predict the future, which, well, is unpredictable.
So don't expect to be right all the time.
Be comfortable with not knowing everything. Be prepared to adapt.
The process, right?
Exactly. Learning, experimenting, refining your approach.
And on that note, I think we've covered it all.
I think so. Data, portfolio management, staying informed, adaptable, ethical.
It's been a truly fascinating deep dive.
It has.
To our listener, we hope you feel empowered to make smarter, more informed decisions.
Absolutely.
Remember, informed investing is a journey, not a destination.
We're all in this together.
So stay curious, stay informed, keep exploring.
The world of finance is waiting.
Thank you for joining us on the deep dive.
Until next time.
Happy investing.